This is the second part of the presentation for Chapter 22, Accounting Changes and Error Analysis. In this objective, we will describe the accounting for correction of errors. This slide shows some of the types of accounting errors that can occur. As we discussed in the first presentation, changing from an accounting principle that is not accepted to one that is accepted is considered to be an error rather than a change in accounting principle. Other types of errors that can occur are mathematical mistakes or a failure to accrue or defer expenses or revenues, also misclassification of costs or expenses as assets and vice versa. We would also characterize as errors when management either misuses facts or makes changes in estimates that were not made originally in good faith. We discussed in the first presentation that estimates should always be made carefully because if they are not, then later changes in estimates would be considered errors. The accounting standards require that we correct all material errors. Immaterial errors do not have to be corrected. Error corrections are done retrospectively by adjusting the beginning balance of retained earnings in the current period. Also, there should be restatement of all prior periods that are presented together. The process is the same that we use for changes in accounting principle, but we call the correction of errors prior period adjustments. To illustrate accounting for error corrections, we will look at an example where the bookkeeper for Selectro discovered in 2021 that an error was made in 2020 when the company failed to record $20,000 of depreciation expense for a newly constructed building. The company correctly included the depreciation expense on its tax return, so income taxes payable was correct. This slide shows selected income statement information both with and without the depreciation expense error. The first step in the process of error correction is analyzing the effects of the error. We see that net income was overstated by $16,000 net of tax because the depreciation expense of $20,000 was omitted and income tax expense was overstated by $4,000. This slide shows the entry that was made with the error and the entries that should have been made. The depreciation expense entry was not made. However, the depreciation expense was correctly reported on the tax return. This difference created a deferred tax liability of $4,000 to account for the difference in financial income tax expense of $20,000 and income tax payable on the tax return of $16,000. We have discussed the income statement effects. The depreciation expense was understated by $20,000. Income tax expense was overstated by $4,000 and net income was overstated by $16,000. It is also important to analyze the balance sheet effects. Accumulated depreciation was understated by $20,000 and deferred tax liability overstated by $4,000. Both of these accounts will need to be corrected as we shall see in the next slide. Now we are going to record the entry to correct the error. It is important to remember that the books for 2020 have been closed, so it is not possible to just record the depreciation expense entry that was omitted. The error has to be corrected through retained earnings. The net income that was overstated by $16,000 would be debited to retained earnings. Also, the deferred tax liability that was recorded in error would need to be reversed, so we will debit it for $4,000. We also need to record the $20,000 of accumulated depreciation buildings by crediting it. To show the prior period adjustment on the 2021 income statements, Selectro would show the subtraction of the $16,000 net income from the beginning retained earnings as of January 1st, 2021 of $350,000. The net income of $400,000 for 2021 would be correct, since the depreciation expense for 2021 was not in error. When companies present comparative financial statements, they should adjust all affected accounts for all periods shown. This means that these accounts for all prior periods should be restated to the correct amounts. The catch-up adjustment for the periods not shown is made to the retained earnings for the earliest period reported, as we saw in the Selectro example. This is the same method that was used for changes in accounting principles. In summary, we use the retrospective approach for changes in accounting principle as long as it is practical to do so. This involves presenting all comparative financial statements on the new principle, disclosing the effects of the change on net income and earnings per share for all periods presented, and adjusting the beginning balance of retained earnings for the cumulative effect of the change on all prior periods not presented. For those rare cases where it is impractical to use retrospective treatment, the new principle will be applied currently and prospectively, and full disclosure should be made. For changes in accounting estimate, we will use the prospective treatment, which means that the current and future periods will be presented using the new principle, but no restatement or cumulative effect on retained earnings is required. Disclosure is only required when there are material changes or for those that affect many years. Changes in reporting entity require retrospective treatment in most cases. For error corrections, there should be restatement of all periods presented and adjustment of the beginning retained earnings for the first period presented for the cumulative effect on prior periods not presented. The authors discuss some of the reasons why companies change accounting methods. One reason is that large companies receiving more attention prefer more conservative policies to reduce political cost. Companies that have large amounts of debt may prefer policies that will not increase their debt levels. Managers tend to prefer principles that boost their bonuses that may be based on revenue or net income. Companies tend toward smoothing earnings by choosing policies that reduce volatility in net income. In this objective, we will focus our attention on how to analyze the effects of errors on the income statement and the balance sheet. We saw in the illustration with Selectro that when a company discovers an error, they first need to determine what type of error occurred, and then the entry needed to correct the error. Also, if the company presents comparative financial statements, they would need to determine whether prior periods need to be restated. Errors that require prior period adjustments will be corrected by adjusting the assets and liabilities affected by the error and retained earnings for the income statement effects. Classification errors occur when an amount is debited or credited to the wrong account. For classification errors affecting only the balance sheet, we would need to reclassify the amount to the correct account for the current period and all prior periods that are presented for comparative purposes. An example of a balance sheet classification error would be the recording of a liability as long-term when it should have been reported as current. To correct this error, we would need to move the amount to the current liability section instead of long-term liability section for all periods affected. This is also true for classification errors for revenues and expenses on the income statement. We would credit the error by removing it from the incorrect account and moving it to the correct account for all periods presented. An example of a classification error on the income statement might be the inclusion of interest expense incorrectly as marketing expense. Errors that affect both the balance sheet and the income statement are of two types: counterbalancing errors and non-counterbalancing errors. We will first discuss counterbalancing errors. Counterbalancing errors are those that correct themselves over two periods. The journal entry to correct the error would depend on when you discover it, either when the books are still open or when they are closed. If the error is not discovered until after the books are closed and the error has already corrected itself, no entry would be necessary. If the entry is found after the books are closed but the error has not corrected itself, then there would need to be a correction to retained earnings. An example of a counterbalancing error would be the failure to accrue salaries expense at the end of the period. This error would understate salaries expense and salaries payable in the first year and overstate them by the same amount in the next period. However, the error would self-correct or counterbalance over the two periods. If the counterbalancing error is discovered in the first period before the books are closed, then you would just make the entry that was omitted. If the entry is discovered after the first year is closed, but the entry has not yet counterbalanced, you would make the journal entry, but you would debit or credit retained earnings as we discussed in the previous slide. To illustrate counterbalancing errors and what entries are needed to correct them, this slide shows the correction of a failure to accrue salaries and wages expense for $2,200. In the first column are the corrections for the first year, depending on whether the error is discovered before the books are closed or after. If the error is discovered before the books are closed in the first year, then just make the adjusting entry as it should have been recorded by debiting salaries and wages expense and crediting salaries and wages payable for $2,200. If the error is discovered after the books are closed in the first year, then the debit would be to retained earnings instead of salaries and wages expense, and a credit made to salaries and wages payable for $2,200. This is because salaries and wages expense would have already been closed. If the error is not discovered until the second year, after the wages have been paid, but before the books are closed, then the entry to correct this error would be to debit retained earnings for $2,200, but now the credit would be to salaries and wages expense for the same amount. This corrects the salaries and wages expense in the second year that is overstated. There is no need to credit salaries and wages payable because they have already been paid. Now, if the error is not discovered until after the books for the second year have been closed, there is no need to make an entry because the overstated salaries and wages expense would have already been closed to retained earnings and the error counterbalanced. Non-counterbalancing errors are those that do not offset in the next accounting period. For these types of errors, companies must always make correcting entries even if the books have been closed. An example of a non-counterbalancing error would be an error in recording depreciation expense, such as not subtracting the residual value. This error would not correct or counterbalance in the next period. To illustrate correcting entries before and after books are closed, we are given a partial trial balance for Julie Hartsack Corporation as of December 31, 2021. Notice that we have some amounts already recorded with debits to supplies, interest receivable, and prepaid insurance, and credits to salaries and wages payable and interest payable. In the next slides, we are going to be given information about errors that were made affecting this company, and we will be making entries to correct the books both before and after the books are closed. In this slide, we are going to first examine the entries to correct supplies expense. The original supplies purchased were $2,700. The physical count on December 31st, 2021 totaled $1,100. To correct the supplies expense if the books are open would be a debit to supplies expense. But if the books are closed, the debit would be to retained earnings for $1,600. This is the difference between the $2,700 originally purchased and the $1,100 that we still have in supplies. The credit would be to supplies for $1,600. The second entry concerns salaries and wages expense. The entry was made originally for $1,500, but the correct amount is $4,400. To correct this, we would need to debit salaries and wages expense for $2,900 if the books are still open, or retained earnings if they are closed. We would also need to debit salaries and wages payable for the same amount. In the first entry in this slide, we originally recorded interest receivable and revenue of $5,100. After review, we found that the accrued interest was actually only $4,350. To correct this entry, we would need to debit interest revenue if the books are open, or retained earnings if closed for $750, the amount of overstated interest revenue. We would credit interest receivable for the same amount. Next, we originally paid $90,000 in prepaid insurance. The unexpired portion at December 31st, 2021 was $65,000. To adjust prepaid insurance, we would debit insurance expense if the books are open, or retained earnings if closed for the expired portion of $25,000. The credit would be to prepaid insurance. In the first entry on this slide, we see that we recorded rental income, the entire $28,000 that was received, that was actually in payment of rent for 2021 and 2022. To correct this, we would debit rental income if the books are open, or retained earnings if closed for $14,000. We would credit unearned rent revenue for the same amount. For the second entry, we recorded depreciation expense of $5,000 when the correct amount was $50,000. To correct this, we would debit depreciation expense if the books are open, or retained earnings if closed for $45,000. We would also need to credit accumulated depreciation for the same amount. In this learning objective for the appendix, we will make the computations and entries necessary for recording changes from and to the equity method of accounting. If you remember from the first presentation, changes in reporting entity normally require retrospective treatment. However, it was noted that there are exceptions to that rule, and the first exception is when a company changes from the equity method to the fair value method. The FASB decided that it is impractical to use retrospective treatment for this change, and therefore a change from the equity method to the fair value method will be handled prospectively in the current and future periods. A company will change from the equity method to fair value when the level of ownership or influence diminishes such that the equity method is no longer applicable. At the time of the change, the value existing in the investment account will become the cost basis. The company will then compare this cost to the fair value at the end of each reporting period and make an adjustment to record the unrealized holding gains and losses based on the difference between the carrying amount and the fair value. One caveat that applies to changes from the equity method to the fair value method is the requirement to record dividends received from the investee in excess of the income that would be attributed to the company if the equity method was still being used. The dividends in excess of income are viewed as liquidating dividends, and these are required to be credited to the investment account rather than credited to dividend revenue. To illustrate changing from the equity to the fair value method, we will look at an example where a company originally purchased 250,000 shares of the investees' 1 million shares of outstanding stock for $8,500,000 and correctly used the equity method. At December 31st, 2019, the investor company reported its investment at $8,780,000. On January 2nd, 2020, investee sold an additional 1,500,000 shares of common stock, and investor company did not purchase any of the additional shares, thereby reducing its ownership percentage from 25% to 10%. This slide shows investors' percentage of investees' income for 2020 through 2022. We will use this information to determine the liquidating dividends that will need to be credited to the investment account rather than to dividend income. The slide above shows at the top the dividend revenue recognized. The calculation of the cumulative excess of share of earnings over dividends received and the investment balance at December 31st, 2020 through 2022. In the first year after the equity method was no longer used, investors' share of investees' net income was $600,000 and dividends received were $400,000. Therefore, there were no liquidating dividends, and all the dividends were credited to dividend revenue, and the difference of $200,000 is added to the cumulative excess of earnings over dividends received to be used in future periods to offset any liquidating dividends. In the next year, investors' share of investees' net income was $350,000, and dividends received were $400,000 again. The excess of $50,000 was subtracted from the cumulative excess of earnings over dividends of $200,000, and all of the dividends were credited to dividend revenue. In the third year, however, the investee did not report any earnings, but the investor received $210,000 in dividends. Since there remained only $150,000 in the cumulative excess of earnings over dividends from 2021, dividend income was credited for $150,000, but the remaining dividends of $60,000 were credited to the investment account as liquidating dividends. When a company's level of ownership or influence increases, so that the company no longer uses the fair value method of accounting for an investment in equity, but is now required to use the equity method, the FASB has also decided that prospective treatment should be used. Prospective treatment means that on the date of the change, the company would add the additional cost of the new stock to the cost basis of their previously held interest and begin to record its percentage ownership in the investee's net income or loss as an addition to or reduction in the value of the investment. Dividends received after the change to the equity method would be credited to the investment account instead of dividend income. The company would also need to adjust the fair value adjustment account associated with the investment to retained earnings in the period that the company begins using the equity method. These are your quiz hints for Chapter 22. Again, it is best to do the homework before attempting the quizzes. These are the review items for problems from Chapter 22. This is the end of the second part of the presentation for Chapter 22, Accounting for Changes and Error Analysis.